What's going on, everybody? Spencer Gray. Welcome to the Gray Report. If you're a multifamily investor, you're thinking about getting into the multifamily investing business or just the multifamily industry, maybe you're already in the multifamily industry, this is the show for you, where every week we're breaking down exactly what's going on in the market, breaking down the latest research reports, all the new data sets, articles, everything that comes out related to the multifamily industry, real estate industry in general, but also the economy and all those macro events that really kind of just drive the market in general, while also, paying close to the very hyper local markets and submarkets that tell their own unique story. I am on location right now. I'm in West Palm Beach. I've been at a family office conference. I've been talking to a lot of family offices, multifamily offices, wealth managers, really trying to understand where the wealthiest families in the world are allocating their capital towards right now. There's some asset classes that you can probably guess, but there's a few others that I think you may be a little bit surprised. So let's bring Matt Bossnagel in. Let's get into it. What I've been seeing, also what's going on in the market. So let's just get into it. All right, everybody. Matt Bossnagel, we're bringing him in like we do. I don't know why we say we're bringing you in. Matt Bossnagel's here like he is every week. He's a director of communications and marketing at Gray Capital. If you are receiving the Gray Capital newsletter, comes out. Our main piece comes out every Thursday. We send you a little update on Sunday. He's the master that's putting this thing together, doing tons of research. He's got a whole team behind him. We're really proud of what you do, Matt. It's a great newsletter. Sign up, graycapitalllc.com. How's your week going? What's going on there up in Indianapolis?
Pretty good. Second you left, cold snap. So we're all bundled up. But that's what happens. That's timing your trips perfectly.
Timing is timing. Whether in the market, it's difficult. It's hard to get it right. But when they say time in the market is just as good, and sometimes you get lucky. But all right, December Indianapolis versus December in Florida.
Yeah, that's an easy choice.
Yeah, exactly. Well, first, Matt, I just wanted to kind of share with you, we were talking about it a little bit, but I've been having some really interesting conversations. And so I wanted to share with you, all viewers, listeners, kind of just what's been going on. I'm at an event. It's a 3-day event, family offices from mostly the United States, but also from really around the world. I've been speaking to folks from, South America, Central America, Europe, Russia, and then, all across the United States. A lot of commonalities, a lot of focus on, what do we do in this inflationary environment that almost no investment advisor, wealth manager has really invested in a environment with a rising inflation and potentially rising interest rates. I was having a conversation that you really have to be in your mid to late 80s to have been an active, wealth manager during the early to mid 70s to really have any frame of reference of what's going on. Maybe you could have been, late teenager, early mid 20s, and you're still working now. And so maybe you remember it, but you weren't necessarily in the trenches making those decisions. So we're really entering into a new, economic time that, is really unprecedented, not to mention the fact that, driven by a pandemic. And so there's a lot of just interesting confluences, and everybody's trying to kind of figure it out. So I paid a lot of attention. I had some really interesting conversations. There were a handful of asset classes people are investing in that I found interesting. Now I'll save the obvious one to kind of the end. But one which is sort of surprising, you hear a lot of talk about, but that's cannabis. Ton of family office investors in general are trying to hitch their wagon to this whole green rush that's happening. Because there's the majority of countries in the United States right now have some form of legal marijuana or cannabis, whether that's from the medical side or full recreational. And without the banking system really being able to really handle cash flows coming into these dispensaries, it's created this weird patchwork and with a lot of problems. And when there are a lot of problems, there's people trying to find solutions, and you create a solution, you've got a pretty good investment idea. And so there's a lot of, they see this as a revolution, and it's taking over. The cat's out of the bag, genie's out of the bottle, or whatever.
Yeah.
How do you get involved in it? I mean, it's growing so fast, but a lot of families don't necessarily want to invest in the production of like the growing, but it's all right. How do I invest in the processing systems for either on the banking side or whether it's the packaging side?
Oh yeah.
Or maybe it's just the retail or the real estate. Like, okay, I'll buy the warehouse and lease it to you. But I don't want to actually invest in the business itself.
It is like it's a normal job now. It's a growing normal industry, and it is not the hippie weirdos at all. These are like clean cut, this very polished image that these early adopters, at least in a lot of places of legal cannabis organizations, are taking.
Yeah,
that's my impression at least.
It's big. It's big business, and I think that there are a lot of kind of more amateur or kind of the hippies or whatever you want to call them who got into it, and some of them probably know what they're doing. Some don't. I was having a conversation. It's one thing to grow some weed in your basement with a couple of grow lights. It's a whole other thing to really be in the business of industrial agriculture, industrial plant production. I was in the agriculture industry for a while. I owned a hop business. We grew hops. We also were brokering hops for the craft beer industry. Hops and marijuana are actually, they're in the same family. They have a lot of relation. We were having conversations with a lot of people in the cannabis industry at the time. I talked to a lot of people who were getting ready to get into the space, and they saw it as like they were producing widgets and like, we're going to scale and do all this stuff.
Yeah.
I'm like, well, have you ever grown anything at scale? It's not easy. It's hard to really scale up. And again, you could have a grower who's got some experience, but again, can they actually scale what they're doing? So there's been a lot of bifurcation, but the cream's rising to the top right now. People who are serious know what they're doing. They're creating some investable companies.
And I think it is worth mentioning too that a lot of these states have significant hurdles for companies to jump through that make it a little bit more difficult to enter the space. And the fact that there are companies that are still doing that and still, at least as far as I know, they're making a lot of money on it is a good sign. Now, it could be a little bit of like regulatory capture in that these companies have a hand in kind of suppressing the new businesses getting on board. But it does seem like it seems like in spite of a very tight and regulated control in some states, that there are businesses that are making profits. So
for sure. So the next piece is, I don't know why I think these two are related, but crypto. Obviously the huge crypto craze. We've talked about cryptocurrencies. We track cryptocurrencies on Gray Report, on the newsletter. Less interest in buying the actual tokens or currencies. More interested in back-end technology and just blockchain-oriented technology. I could multiple times like, I'm not really investing in the coins. Maybe I've bought a little Bitcoin here or there, but they're really interested in just blockchain technology and practical solutions and applications that are really solving problems. Matt, we were talking just before we went on, there's a lot of solutions in search of a problem. A lot of discussion of tokenizing things that don't need to be tokenized, putting things on the blockchain that doesn't really help solve a problem. I heard someone talking about, not this conference, but I watched a video recently, this guy talking about these decentralized autonomous organizations that are essentially run off of smart contracts. Basically think of a company, but its operating agreement is all in the smart contract, and it is really purely democratic organization of where your tokens and voting rights and all that. It's all digital. It's all done on the blockchain. His idea was basically to create like a gym, like a fitness gym, and he basically said how people were going, early investors were going to get a certain amount of return, and then you'd get these NFTs as your membership cards, and you could get like perks for going to the gym. And I'm like, why? There's no problem you're solving there.
Yeah.
It's like you could just. Because he was like, they don't have one piece of equipment, so I'm going to open my own gym. Well, you could open your own gym right now, get investors, give them, whatever return profile for whenever they invest, do different rounds of investment, and you can have punch cards or whatever member benefits. You don't need NFTs for that. Like, it might be cool to do, but there's no problem being solved. But in other cases, there are.
And that's what seems to be the most interesting for me is like what are their opportunities? Because if you had to start from the ground up, if there were not systems, it seems like it would make sense
Yeah.
to implement some blockchain technology to track transactions. And especially, you get like a deed or a contract that is, that's on the blockchain, and it's locked down in a way that papers and files may not be. And it seems like that could really help. But there's a lot of people and there's a lot of systems that's already doing that. And it would take a whole lot of work to just switch it right over.
And that's the problem, is we've got a system that, we've been doing it. It's been fine. We don't want to throw the baby out with the bathwater. But I do think, just thinking about operating agreements. There's, even though you're laying out how everything should happen in a business with certain events, there's still interpretation. Language gets put in that is, purposely vague for whatever reason. And there can be some interpretation. Some people don't even look at their operating agreement or follow it. What a smart contract does is it takes all that, the opinions out, the interpretations, and getting a lawyer to look at it removes the trust. There's no trust involved. It's just truth. Like, you don't have to trust anybody. It's 100%. It is what it is. A smart contract. It follows the math, and the math doesn't lie. So I think that, from a financial perspective, I think is very powerful, and it does solve multiple problems of, if we've got this document now, 3 different people are going to interpret a section, a couple different ways. Really interesting conversation. Fast forwarding to continue to talk about real estate, but is the tokenization of real estate. In this debate, it was a really interesting roundtable discussion that I was involved in about the whole concept of the tokenization of real estate. One group, was really making some headway, haven't got it completely figured out. They're essentially doing multiple Reg A fundraisers, and those Reg A investments are going to be tokenized, and you put on the blockchain, and eventually the Reg A piece goes away and dissolved, and then they just have the tokenized real estate. They haven't done it yet, but they're in the works right now, setting up their Reg A's.
You tokenize this. What would that allow you to do? That opens it up, right?
Well, so the question is, what's the point? And what problems are you solving for? The first problem you're solving for is liquidity. Right now in real estate, there are no real secondary markets for, units of private placement. So you invest in, real estate syndication, you have that unit, but if you want to get out early, or if you want to buy in afterwards, there's no real secondary market. It's kind of a long process. Oftentimes you have to get permission from the manager, the sponsor. There's no real open market. So it's just negotiating, what am I going to pay for? What are you going to buy it for? If it was tokenized, you could just sell that token that includes the membership to that investment on, theoretically, any exchange that allows you to sell it. There's no permissions necessarily required, although I guess theoretically they could be. But what the problem it's solving for is liquidity. So all of a sudden you invest in a real estate project and it's doing really well, like really well. Like, so, let's say, we'll talk about apartments, they've increased the rents, NOI is up, doing really great. It's got good track record. You invested, before they bought it or whenever. You may want to cash out for whatever reason, but you don't want to wait for the sponsor to sell. You can go on to an exchange, sell your token right away, and there's no restrictions. And then the big question is, the price. It has to be relative to the actual fair value, intrinsic value of the asset. It's like, well, yeah, it's sort of relative, but what really matters, we're really allowing the market to take place. An individual could say, okay, so that token it's throwing off an 8% cash on cash return. I think that there's more upside to the project. I'll pay twice what you paid for it. I'll take a 4% cash on cash return because I believe in the upside. And so we're allowing the market to take place to really set these prices, as the project is going on. And so you're adding a lot of higher frequency trading possibilities and price discovery on these, what were formerly private placements. And it could really change the market, because then all of a sudden, as the comment was, you guys like, well, the value has to be related to the real estate. the response was, well, what does the value of AMC and their, cash flow have to do with the price?
That is my, I was going to say, well, volatility is my kind of my concern there.
Volatility and speculation.
Yeah.
And in real estate, we're like, well, the reason we like real estate is because, well, the issue was, okay, well, does that make these real estate investments more correlated to the market? We like real estate because of its uncorrelated factors to public markets. It's higher frequency, higher volatility. Does that, we all of a sudden you're more correlated. And I think that could be the case. It doesn't make real estate a poor, a worse investment compared to any other type of, public security that you can buy. But really the result of all this is you're making the market efficient.
Yeah.
Real estate is very efficient. Now you could say, I have the opinion that real estate is a great investment because of the inefficiencies. You can take advantage of that. But efficient markets are better for the market.
Yeah,
and
for sure.
Eventually can be less volatility.
And with volatility, there is an association of a larger upside if if you're making the right decisions. But my bigger point would be that there is a fundamental aspect of real estate. It's going to be a physical asset. Its value is still going to be tied at least somewhat to the kind of the cash flow that will present, and that's not going to change through the course of an investment.
And it's really no different than any other company. And really, the derivatives, the financial derivatives, whether that's be options or different types of stocks, different types of derivative instruments, it's really no different. That's already happened, but you're doing on the blockchain, which I think you could argue is just a much better system. And to your point, if we threw everything out, we had to start from scratch, we would use the blockchain.
Yeah.
And so it's really no different theoretically. That's already happened to the financial system. It's just being done in maybe a better way. And it's very similar to what happened in the 80s with REITs. REITs allowed individuals to buy commercial real estate on the stock market, to buy a fraction. It's the fractionization of real estate. I can take $100 and invest in a company that's buying a skyscraper in San Francisco. Now the same thing is going to happen with tokenization. I'm going to buy $50 of a token and invest in multifamily property in, Kansas City or wherever, and I can sell it. And that led to this whole idea of, kind of the old guard saying, well, why would I do this? I don't need to do this. And I'm probably not going to do it. And that's okay. And what they weren't understanding from my perspective is, this opens up real estate investing to a whole new cohort of investors. The crypto investors, millennials, Gen Zers, who still like the idea of buying real estate, but they're doing but they want to invest on their phone. They want to invest through Robinhood or wherever, and they get crypto, they get the blockchain. It makes sense for them. And so you're growing the pie of investors into real estate, not to mention foreign investors. It really grows the pie. Now, regulation that's a whole other, can of worms that I don't even know where to start, because it's much more unregulated. And I think regulation is going to still be slow to catch up until they make a mistake and they could easily, screw things up because they don't understand it. But it was fascinating discussion, and the feeling and what people are saying is that it's going to be here sooner than we think. The prediction, Blackstone is going to be having tokenized funds the next 18 months.
Well, and I could see a lot of firms doing it for just because they speculate and they know where it's going, and some are going to do it because it's appealing. Some are going to do it, and this is from a marketing perspective, because it'll get them noticed. But I don't think that there's a real good reason to not try this out if you're able to.
I think, and that's what I'm waiting for, because we've talked about this a lot in the past. This isn't the first discussion that we've had, at least internally, about tokenization, different ways to do it. I don't want to be necessarily the first, or our investors to be the guinea pigs. I want to find a structure that really makes sense, that's solid. But as soon as we can find that, I think that having that as an offering makes a lot of sense, because I think it is the future.
Spencer, what do you think about The metaverse.
Oh man, surprisingly, the metaverse. I think we have to talk about it. Surprisingly, not as much conversation about the metaverse at this conference, but the whole buying real estate in the metaverse. I'm conflicted because it's like, I guess I don't see why not. People put value to things. We things are valuable as we give it value. There's no inherent value that that really exists. So it's outside cash flows, and I don't know. It's fascinating. I'm not going to go buy a big chunk of land in the metaverse, but I don't know. Maybe we should. I saw something online today. It's like you're going to get left out, and you're going to. Someone said, and it made zero sense, but they're like, you can be rich in the real world, but poor in the metaverse. And like, you want to be poor in the metaverse. And my thought was like, that's dumb, because there's an equilibrium. There's going to be changes.
Yeah.
And I was saying, reading *Sapiens* and talking about how quickly back in, 1400s or whenever, when the first Italian, Marco Polo times, Italian merchants going to China, Chinese going back to Italy. At first, the Chinese were like, we've got gold. What you guys want gold? Like, and they're like, the Italians wanted gold. There was demand for gold. Well, sorry, and the Italians wanted like the spices and like the dyes and everything, but the Chinese they had those. They didn't care about gold. Eventually, the prices of gold and those spices were so different that there was this big arbitrage. You could like get gold for cheap in China and bring it back to Italy, along with your spices and dyes and whatever. It didn't take very long, even though you had to, think about going from China to Italy back in the 1400s. It did not take very long for those prices to reach equilibrium.
Yeah.
So,
well, my point, in at least my thought of metaverse, it seems like a fun. It seems, at least this early, like a novelty, but I would be remiss to say that I wouldn't. I want a Gray Capital beachhead in the metaverse, some quiet little corner.
Make a proposal. Let's get on it. That'd be fun. I don't know what we do there, but
I think that there is a benefit to looking into it. It is a new technology, and I think that us ownership, not a significant one, would help us discover the technology. So that's fine.
It's one of those that's like, okay, goes to zero, it's fine. It's amount you can lose. It's like going to a casino. I mean, and that's how I viewed cryptocurrencies, kind of back in the day. It's like, I'm not going all in, but like, all right, with a little bit that if it goes to zero, I'm okay. Then the last, private credit was, a lot of people interested in private credit, looking for yield. Everyone's chasing yield. People looking for, venture capital is always of interest, family offices. But then, no surprise, real estate. Everyone's looking for real estate. It's such a great inflation hedge. Everyone's trying to get yield, trying to find growth. Multifamily, industrial, and then throw self-storage into that industrial, manufactured housing and the multifamily. But residential and industrial assets, where everyone wants to be. Sort of some interest to office, retail, hotels. Not a lot of good news on hotels still.
Yeah.
They're like still below 2019 numbers. And, in resort-oriented hotels, they're doing better. But still a lot of the business hotels, between Zoom and everything else, there may have a hard road ahead. There could be some opportunities at some point. Could be catching a falling knife. We've looked at a couple of those hotel to multifamily conversions, which I think is going to continue to be an opportunity, because a lot of the conversions are some of those business travel destination hotels. So, all right, Matt, that's that's kind of what the scuttlebutt was at this conference. And
I think that's really interesting, and it's good to know that this is still being discussed, and that multifamily specifically, it has a powerful place in in these discussions and conversations that you're having.
Let me just put it in perspective. Talking to any big family office, they're not just investing in real estate. although they are all investing in real estate. Like there's not one that the lowest percentage of their allocations is like 15%, but it's 50, but you see 30%, quite often you see 75% being allocated to real estate. I think 30%, 25 to 30% is about the average I saw for family offices, their allocation of real estate. And I think Camden does a study that actually breaks it down specifically. This is just my anecdotes of talking to 30 or so family offices this week. Yeah, but multifamily, to them, multifamily is a no-brainer. I mean, it has been, it always will be. They're all in it. They're looking for different regions, different geographies. A lot of people have already invested in the Sun Belt. You know, they're in Florida, they're in Texas. They're looking for something else to diversify. And that's where great capital, we invest in the Midwest. You know, that's one of our many differentiating factors, and why I think we were able to gain a decent amount of traction. But one quote I heard is, if you're investing in multifamily and industrial with a long-term outlook, it's very difficult or almost impossible to lose. Not that you can't, people find ways to screw things up, but if you are half a brain cell, multifamily and industrial, you're going to be in a good spot. So
yeah, it's important not to lose.
Don't want to lose. No, well, and that's the thing, because some investors, and they've got a pretty short time horizon, and I get it. You can make more money, higher returns, higher risk, but it's like, man, if we can just take this whole variable of time and just make it not an issue, timing anything, it's hard. You can be right, but you can not be at the right place at the right time. If you're in the market, for the duration, you're gonna come out all right. I mean, pandemic, can't time a pandemic, but if you were in the market already beforehand, you don't have to time the pandemic. It just happens if you understand the fundamentals. And the way we see the fundamentals, we got quite a bit of legs left to run. So
for sure,
that's the report from the conference. Matt, you want to pop right into this NAR?
Yeah, I think that jibes well. Insight. I mean, I'm always looking for a nice segue, but I think that this does segue into the decisions that some of your family offices that you're talking to are making between office or hotels or industrial or multifamily. And NAR does a great job. Every month they come out with this. I always look forward to it. Not the least of which is its ability to track all of these different sectors, and you can kind of figure out where where the top performers are, where the bottom performers are, and it's not a spoiler to say that multifamily is doing well again this year, this month. Specifically, I think they do also talk about, and this is another thing I think that's interesting and a little bit unique about real estate over other, is place is so important. And not all multifamily is not a monolith. Multifamily is not a specific, it's not like an industry. Well, it is, I guess, the multifamily industry. But if you're buying multifamily properties, there's a difference between a property in Miami and a property in Tallahassee. And some of these, and I just like on page 11 of this report, they have a list of these cities where you can find potentially profitable deals where the rent growth is super high, the vacancy rate is super low, and you see a lot of Miami is up there, but other there's Detroit, Columbus, and Cincinnati. There's some Midwestern places too, and it's really across the board where Omaha is a Great Plains states, Sioux Falls, Chattanooga, Knoxville. There's a lot of smaller cities and smaller locations, and this is just kind of the tip of the iceberg. And we've gone through this before. If you really look at submarkets and place, you can get so granular when you're talking about an individual property and choosing to invest in it. So it's just another repeat of it pays to pay attention and to look closely, because sometimes the opportunities are not where everyone's paying attention, and the market is such that right now you'll find something if you look hard enough.
That's I don't understand their cap rates.
Yeah, me neither. It does seem a very rosy.
Well, they're just wrong. You're not buying 8 caps in Columbus.
Yeah.
You're not buying anything above a 5, just about anywhere. Certainly not in Miami, Florida, Tampa, Florida, Fort Lauderdale. You're buying sub 3s right now. So I think that's where I don't, and they got this data from CoStar. CoStar cap rate data cannot be the best. One, it's kind of blended from, they're using a longer time frame. It's also a lot of different asset classes. The CoStar cap rates are always significantly higher than what's going on the ground. Now you can say, oh, maybe you're just overpaying. That's no, it's just they're taking information from, a quadplex,
Okay.
5-unit deal sells for an 8 cap, and they're not selling for 8 cap. So I don't know where they're getting this data from, but it flies in the face of all information I've seen, and not just anecdotally, but from other reports. I haven't seen. I mean, the average cap rate in the United States right now is 4.5%. They have New York at a 5.5%. New York City hasn't been a +5 cap market in probably over a decade. So I think that so take the cap rates out. I think the year-over-year rent growth and the vacancy rate is definitely good to look at, and absorption as well. But their cap rate is, because they're trying to with yield anyway. So enough on that. That's just my criticism for that particular little piece of data.
Yeah. So, and just as it compares to other sectors of the real estate, it does talk about industrial demand remaining strong. The office market, there's kind of a modest performance, to say the least. It's not doing as well as people were really hoping, and but for retail, the occupancy is actually increasing, and that seems to be recovering a little bit. Hotel market is also recovering, but I think that also has a longer way to go, perhaps, than the office market.
Yeah. And again, just from the anecdotes from this week, the ADRs, average daily rent, still way below where they have been historically. There's a lot of forbearance in the hotel industry. And what I found interesting, I didn't know, a lot of the flags, they have these things called PIPs, which I don't know what it stands for because I'm not a hotel guy, but eventually it's like required CapEx. You gotta put in new drapes and new TVs. Like you gotta update, because they want to have uniformity in their properties. And they did not do PIPs they have suspended PIPs. You don't have to put more money into your hotel. They are going to be restarting those, and so hoteliers are going to have to start spending more money, which some aren't going to want to spend the money and probably don't want to sell. So I think we're going to see some distress situations. So it'll be interesting to see over the next couple of years, I think.
Yeah, I just want to call your attention just really quickly on page 2 of this report. There is a nice chart that looks at the rents, and again, this is based on the CoStar data still, but it says rising rents,
Page 2.
I'm sorry, it's page 6.
Oh, okay. Yeah.
It's marked as 2 in the in their PDF. But
I hate the spread between your PDF page and the actual page on the on the document, but maybe tokenization can help with that.
Yeah, that's right. But you can see, and I like this because it has a long time period where they're measuring this in quarters from 2011 to 2021, and you can really see multifamily take off. Whereas offices doing modestly. Like I said, it really suffered. Industrial has a very smooth transition, but it is super dramatic how quickly multifamily has grown. And retail seems to have a similar upswing, but you can see at a glance how different the performance is in these places.
Yeah. Okay. So Matt, Berkadia had really nice piece on really collections and rental payments.
Yeah, I wanted to call some attention to this because for a while our newsletter tracked the NMHC rent payment rate, and I'll get into that in a second. But this one really did a good job of digging into the data that you don't really see in the NMHC rent payment tracker. Specifically, it's talking about how rent payments are lagging in Class C properties, and the current and it is worth noting that year-over-year rates of Class C collections declined much more in 2021 than they did in 2020, and the current payment rate is around 86%. I won't say what this might mean about the economy in general, but I will say that this tracks with the improved rents that we've seen for lifestyle renters rather than renters by necessity. So Class A and Class B properties have been doing well in terms of rent growth as opposed to Class C properties. Now, both of them are experiencing significant rent growth this year, but Class C is lagging, and the rent payment rate seems to be correlated with that rent performance.
Yeah.
Collection rates are a little lower on some locations where a greater proportion of owners are not larger companies, like in New York City. There's a larger proportion of smaller, maybe these are individual owners that they don't necessarily have the systems in place to get rental assistance for Class C renters. So it's some of these markets have collections that are trailing a lot more than others. Specifically, New Orleans is sitting around 85% in collections, as opposed to somewhere like LA where it is like a 94%. So there's a little bit of a difference here, and it is, I think this really opened my eyes. And again, like I said, we haven't been following rent payment that much because the story about rent growth, I almost thought, okay, we don't have to worry about paying. If rent growth is this high, then it seems to imply.
But you assuming people are paying.
Yeah.
But if you can have the rents be whatever they want, you get great rent growth, but no one's going to pay the rent, and actually pays the rent, then well, doesn't really matter if your rent's higher. I'm just it's interesting because on one hand I would say, okay, well maybe there's a little bit of relation between the extended unemployment benefits that burned off, I think starting in July. But the Class C properties, they were already substantially below A and B. That being said, there definitely was even more of a dip down really kind of after in July itself. Not substantially, but a few percentage points. I also, I'm wondering if, if the rental assistance not coming through, because it's theoretically, you should be able to pay if you can't pay your rent, there is assistance out there, unspent rental assistance, hasn't been getting out quick enough. Does everybody have access to it? Again, that's a very local issue because they're being distributed to the states, they're being distributed to local localities, different organizations are providing this assistance, often with local organizations. So it's very balkanized. It's very it's not uniform by any means. It's still probably better than the federal government doing it because that just wouldn't be very efficient. But still, it's definitely not perfect. I think it'll be interesting. We keep tracking wages to see if wages in that bottom quartile are going to start moving.
Yeah.
It's sort of the reason why we focus on Class A and B properties also. And we used to do more Class C assets, and we still have a few in our portfolio. A few that I was a limited partner investor in, and they had major collections issues. Now they've gotten much better. They're back in the 90s. They were back in the mid 80s for a while during the pandemic. But we've got another real, Autumn Trails. I would say is more or less a Class C asset. I think its physical condition is more of a B, but the rent level is more C. We're like 99% collected. It's incredible. And I'd like to say that's the team and everything. It is, but it's still, you can have great teams. Still, people don't pay. So I can't really explain that. I'll take it. We'll keep doing what we've been doing. But
I'm not going to speculate about K-shaped recoveries or anything else other than other than this number is worth watching. And I'm going to segue a little bit into the NMHC rent tracker.
Yeah.
Because if you look at the progress of rent payments from 2019, 2020, and 2021, they have these year over year. You get to see kind of 3 years in line. And this is only tracking from July to December. There is a general trend, it seems like, from rent payments go down a little bit in 2020, they go down a little bit in 2021. Is this, when I first looked at this, it seemed like a pretty easy, a pretty easy conclusion that there were still going to be this consistent lowering. But then I thought about it, and I'm a little less alarmed. So at first I thought, we were talking about this, by the way, in 2020. We said, yes, these are lower rent these are lower collection. This is a pandemic. This is a fluke. But then if you see continued lower collections, then you start, oh, is this a pattern? And I still think, these 3 years are the most horrible years for looking at a pattern, because everything seemed to be unique from the year before. But still, 3 years, is that there's something that's got to be to it. But what I really think that we're seeing instead, yes, there may be a continued amount of decreases, but the curve is flattening. The decrease from 2019 to 2020 was a lot larger in general, in the aggregate, than the decrease from 2020 to 2021. So it's still going down, but it's not going down as much. And it looks like there's a little bit more of an optimistic story to tell here in these numbers than you would think if you just drew a straight line.
Yeah.
So that's
September seemed to be the kind of buck the trend, really on the downside, 72%. Now this is for the first week, I think, collected, not necessarily at the end of the month.
If you scroll down there's a full month figures, and you can kind of see, but this is comparing the 3 years, and you can see this general progression. August, it's a little bit better this year than last year. But it's like boom, 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 boom. And again, I think that what we're seeing is a flattening. That one promising sign, and is what this is just for me looking at the numbers a little bit, is that the decrease has not continued with any significance through 2021. End of month rental payments were around 93% at the beginning of this year in January, and this is if you download the data tables. But from the data tables, the first month of rent in January, about 93%. And then in November, it's about 93%. So it's fairly stable. And again, and some of this is seasonal. So you have to kind of compare winter with winter. But largely, I think that we have kind of staunched the wounds of rent payment decreases of 2020, and we are making a recovery. I have a little bit more confidence in thinking about these numbers and thinking about what the implications are, rather than just glancing at it and seeing this like shocking 3 years of decreases. Yeah. So,
well, I definitely think it's something we need to keep paying attention to, keep tracking. I mean, we really have for the last 18 months or so, really since the pandemic. We were just, pins and needles, March, April, May, June, 2020. So okay, it's not completely falling out. It's a little bit of issues, but it's been on the margins, but it's still, okay, which direction are we going? Now, from a pure fundamental standpoint, the slight loss in collections has been offset by record occupancy and rent growth. That's pure financials. But I think the issue is definitely something for people to pay. How much of this is psychology, with everything that's going on, so people didn't think they had to pay, once we realized that wasn't the case. But I don't know if it's a mindset thing on the margins, but I think we have to keep tracking it though.
Yeah, I agree.
Yeah. All right, Matt. This was a unique episode of the Gray Report. We hit kind of what's going on with family offices. Got into other Gray Reports, NAR, this Berkadia Real Page piece. though, I like staying on track of this stuff as much as possible. One resource to help us do that, we built out, really, Matt, you were a major architect behind it, is greatreport.com. And ask yourself, what is greatreport.com? Well, it is the premier multifamily intelligence aggregator, built by Great Capital. It started out as being really a complement to our weekly newsletter, saying let's keep people up to date every single day without bothering them with an email every single day. If you want emails from us every single day, let us know. Maybe we'll do a special, individual subscription. We want to be respectful of your, we're respectful of your time. But Matt's really been able to develop this great system, aggregating a lot of different content. We've got a lot of RSS feeds going on, little kind of, team of folks that are helping us keep this thing going. But it's updated every single day, not just articles and research reports, but also, videos, podcasts, market updates, everything you need to really stay on top of things. And it's not, we've got plenty of original content, but it's content from all over the place. Even, other syndicators, research groups, data analytics firms. It's all here, greatreport.com. And if you haven't signed up for the Great Report newsletter, that is, it's okay. You haven't completely missed the boat. There's still time. So don't miss out. Sign up for the Great Report newsletter. You can get that sign up page directly at greatcapitalllc.com/newsletter. All we need is your email address. We'd like to know your name, but all we need is your email address. So hop on over to greatreport.com. You can find links to all this stuff. If you're ready to take the next step of, all right, I want to start investing in multifamily real estate. I'm looking for a professional team to do it. We'd love to have a conversation with you at Great Capital, especially if you're an accredited investor, because most of our investment offerings are only open to accredited investors. We're a firm. We have over $500 million of assets under management, 9,000 units across investor portfolios. Our portfolio, we've got over 40 assets of commercial real estate assets that we are invested in. So great team of experts. I'm very proud for what the team's been able to do. We'd love to have a conversation with you. The best way to do that is to join the Great Capital Investment Club. And you can find that over at greatcapitalllc.com. And I would do that now because we are getting ready to launch a fund, the Gray Fund, in January. And if you want to be one of the first investors to kind of get all that information, it's good to sign up for the club now because there's going to be a minimum investment of $100,000. It's a hefty minimum investment. But our minimum investment is actually going to be going up after the first 6 months of our fundraise to $250,000. A lot of this is because we have a lot of large investors who write multi-million-dollar checks, but we want to allow anyone who is serious about getting allocated to have that lower minimum investment of $100,000 in that first 6 months. You say, what are you guys talking about? Your minimum investment is typically $50,000. Well, the fund, we're going to go out and buy 7 to 10 assets. So if you think about it, if we're buying 10 assets, invest $100,000, that's really a minimum of $10,000 per deal. So we're, in a sense, we're lowering our minimum investment, but we don't want you to invest in just a deal. We want you to believe in the strategy, trust in Great Capital, and be part of the team. We're investing our own capital. We'll probably, from my family office to just my own capital, we'll be investing anywhere between $10 and $20 million of our own cash into the fund. So this is significant skin in the game. And if you'd like to invest alongside us, full alignment of interest, we'd love to partner with you. So again, hop on over to greatcapitalllc.com, join our investment club, schedule investment strategy session with one of our investment professionals. Love to have a conversation with you. All right, Matt, any closing words? What do you have? What's going on? I mean, I'm not in the office. Alex is in the office. Again, we're out here West Palm Beach, working really hard on the beach. What's in store? You guys like?
We're staying warm. It's fine. We're fine here. Don't worry about us.
It's fine. How's the heat?
It is.
Staying warm.
We're staying warm. I finally found the thermostat right outside my office, so I have it set to a balmy 72.
Oh, okay, there we go. Good stuff. Awesome, man. All right. Well, we really appreciate everyone who watched this video. Please give us a comment. Tell us what you think about what we were talking about. you're not subscribed, hit the subscribe button. That way you're going to get these updates. We're not going to bother you, but we do these videos once a week. And gently press the like button. It would shows us, okay, we're on to something here, and let's keep doing it. So thank you for watching this. Matt, thanks again for being on the Gray Report. All good stuff. See you everybody next week.
See ya.